Very good morning, friends. So I hope you're all doing well. And most importantly, as I keep always saying, that I hope your cumulative revisions are also going on. So we are today on the last leg of consolidation standards. We've done a couple of inputs on consolidation, and we are working on Ind AS 28. We started off the inputs on Ind AS 28, that is investment in associate and joint ventures in the last class, and we did some inputs regarding the scope of the standard. Now, just to give you the connect in terms of what we've been discussing and what is the quick blocks in which we have divided a standard. So just to give you the quick inputs before we begin on Ind AS 28. So we decided that as far as Ind AS 28 is concerned, we can easily divide this standard in a 3-block in order to get a complete hold on the standard. So of course the standard is called investment in associate and JV, investment in associate and joint ventures, though the concept of joint ventures stems out of Ind AS 111. But then we know that once it becomes a JV, you are taken back to Ind AS 28. Now, in order to understand the standard, I divided this in total 3 blocks. And we said that the first block on the block number 1 is, first of all, understanding the cases where you are given an exemption. So basically understanding the scope of the standard where we are given exemptions, that in which cases we are not required to do a consolidation as per this. So typically the focus is in terms of para number 17, para number 18 and para number 19. I gave you an overview. We're going to go deep today into it, and we'll also do some good case studies on the concept of para number 17, 18, 19. In the study material also you'll see this discussed in a great length. Now, after you've understood the scope of the standard, we need to see how do we assess a significant influence. We've already seen that once a particular investor is got directly or indirectly, and when we say the word indirectly, immediately what should come to the mind is indirectly through a subsidiary. So when you've got direct investment or indirectly through a subsidiary, resulting in a 20% or more than 20% stake, there is a presumption that significant influence is present, unless you can prove it to the contrary. And goes vice versa, that if you've got less than 20% stake, there is no significant influence unless it can be proven otherwise. So we just saw that thumb rule, but we still need to work upon that thumb rule as well. So we said in this particular case, the presumption, which of course can be challenged, the presumption is that you've got directly, and what is important is or indirectly. And when you use the word indirectly, immediately what should shoot in the mind is indirectly through subsidiary. So your indirect percentage should be routed through a subsidiary, that you've got directly or indirectly 20% or more voting power in the investee. There is a presumption that a significant influence is present, but as I said, that this presumption can be challenged. So we're yet to see how this presumption will get challenged. This is what we're going to work upon today as well. So your block number 1 will be concentrated in terms of understanding that, yes, am I getting any kind of exemptions from consolidation? And how do you get the significant influence assessment? There is a thumb rule, but what are the parameters further to be evaluated? Then we go on to the block number 2, which is the core accounting portion. So then we go to the block number 2, which is the pure accounting portion, wherein we need to see that there is a different accounting technique for consolidation, which we call commonly as one-line consolidation, or you can say equity method of consolidation as a technical term. So the method we need to understand is equity method of accounting. And this equity method of accounting commonly is also called as one line consolidation. So we will see in detail how does this concept apply. How does a company apply an equity method of consolidation when you need to present the investment in the consolidated balance sheet? And last but not the least is the block number 3, which is like a special issue. The block number 3 is like a special issue, and this is a discussion on one of the agendas which is given in the appendix to the standard. And there is an illustration of the study material, also wonderful indeed, wherein we're going to see other long-term interest in the associate. As an investor, apart from the equity shares, you could also have other kind of investments which is long-term in nature. So we're going to look at this special issue which is called other long-term interest. Other long-term interest in the associate company. How does it impact the accounting of the equity method? So this is how this is going to impact the accounting of the equity method. So broadly, when you're approaching this particular standard, just keep these 3 blocks in mind, and we're going to go on a chronological order. So let's, I think, begin the inputs in terms of the scope of the standard. I gave you the framework, but I know that was quite technical indeed. Now we're going to go deep in terms of para 17, 18, 19. I'll give you the notes also, and we'll also go to do some good, interesting case studies as well. And one of the case studies is what you're going to love, because this is one of the case studies which I took from the education material issued by the Institute of Chartered Accountants, and this is one of the very interesting case studies on the scope. So a few case studies which are there in the study mat as well, but one of them is in the education material, which is going to open your interesting eyes. Okay, let's begin the journey. And let's, I think, first of all, focus in terms of the scope of the standard, which is application of the equity method. So let's first of all understand that just like Ind AS 110, where there was a para number 4 small a, and there was a para number 4b, 4a rather, I would say 4b, in those particular cases, we saw that there were certain choices under para 4a, and there were certain mandates under para number 4b where you could not consolidate. So we here also under equity method, we are given using the equity method. It says except when that investment qualifies for exemption, when it qualifies for exemptions in accordance with para number 17 to 19. Oh, okay. Sometimes, when I am started speaking technical things, this happens with me most of the times. Something or the other gets technically disturbed. Anyway, I think we're still going to go on with technical stuff. So it says an entity which has got a joint control or a significant influence over the investee is mandated to apply an equity method of accounting. But it says there are certain exceptions where you are going to get some exemptions under para number 17 and para number 19. So let's look at para number 17, where of course this is quite, inputs based on Ind AS 110. Let's see. It says an entity need not apply. So when you say it need not apply, it is giving an option, it is giving a choice. It is giving an option, it is giving a choice. So it says an entity need not apply the equity method to its investment in associate or JV if the entity is a parent that is exempt from preparing consolidated financial statements by the scope exception of para number 4A of Ind AS 110. Or the following apply. Let's, I think, concentrate only on this part of para number 17. So as I said earlier, let's imagine there is a company A and it has got investments in B and C. So let's consider that A has got a control in terms of B and A has got a significant influence or a joint control over C. So it has got basically two investments. One is in terms of, you can say B, where it has got a control, and one is C, where there is a significant influence or associate. Now let's go back to Ind AS 110. And if you remember that if there is somebody on the top of A, let's say for example, there is a company X. Let's imagine there is a company X. Now we're looking at the chain X, A, and B. So if you're looking at the chain X, A, and B, so X has got a control over A and A's also got a control over B. So in this particular case, when you're looking at this portion chain, what comes in the mind is para number 4A. And the para number 4A had a total of 4 conditions. One is that A is supposed to be wholly owned subsidiary of X, or it is a partly owned subsidiary of X, and where we need an NOC that they are okay with the fact that A does not make a console. Then A is not a listed company, then A is not in the process of getting listed as well, and the ultimate or the intermediate parent, that is X, makes a console as per Ind AS and it is meant for public use. In those cases, A gets a choice. In those cases, A gets a choice under Ind AS 110. So para number 4A of Ind AS 110 gives a choice to A that he may not consolidate B. So this is the chain what we saw in terms of Ind AS 110, that para number 4A, 4 conditions are met, so E gets a choice. Now, coming back to the portion on this. Now we're looking at the chain X, A, and C. If you're telling A not to consolidate B, why should I tell A to consolidate C as well? You should be given an equal level of choice as well. So para number 17 is trying to maintain the parity of para number 4A. I know I'm speaking para numbers, but this is to give you a complete clarity of thoughts. And I'll document the notes later, don't worry. So we can say when A is given a choice under para number 4A of 110, why not also give him a choice in terms of the associate company as well? So para number 17 maintains the parity of giving this choice to A because he is also given a choice under 110. Now you can read this para once again. An entity, we're looking at A in the example. A need not apply equity method to its investment in associate or JV, that is C. If the entity is a parent, oh God. Technical, my discussions, my system has not been able to digest this fact. Let me just come back on the agenda. So I was giving you the inputs in terms of para number 17, just a final read on it. It says an entity need not apply the equity method to investment in associate or joint venture if A is a parent and is exempt from making consolidated financial statements by the scope exception in para number 4A of Ind AS 110. So a company which is a parent and is also got an associate. So you got a subsidiary, you got an associate, and for the subsidiary, you are getting the exemption, the choice under 110 para 4A. You would also get a choice under Ind AS 28, that is para number 17. I hope, friends, I am clear with the inputs on para number 17. This is case 1. This is case 1, which is a part of the chain holding where you get a choice as a parent. You should also get a choice under Ind AS 28 as an investor in an associate. Right, so far so good. I hope I'm clear on the agenda. Now let's go on to the para number 18 as well as para number 19. So this is interesting. Let's look at the para number 18 and the para number 19. Now, I'll tell you the distinction between the para number 18 and 19 also very clear. Once we have read them, then we'll do case study. We'll make the notes as well. No worry on the notes. It says when an investment in an associate or a JV is held by or it is held indirectly through. When you say indirectly through, it always means indirectly through a subsidiary. Because whenever you're looking at Ind AS 28 and you say that you've got a direct investment, fine. But when you say you've got an indirect investment, it is always implied that it is through a subsidiary. So when the investment is held by an venture capital organization, a mutual fund, a unit trust, and similar entities, the entity may elect, again an option, to measure that investment at FVTPL in accordance with Ind AS 109. Oh my God.
Video is again off.
I don't know why there is an issue, I guess.
So now it's visible.
Yeah, I don't know what is the issue today. I hope it works. So it says in para number 18 very clearly that it says when an investment in associate or JV is held by. So let's take two examples. It's A and B. And let's take a chain that is A in B and B in C. So let's first consider that A is got in B a significant influence or a joint control. And let's say A is got a control over B and B is got a significant influence or a joint control. So there are two cases which is coming in terms of para number 18. One is no chain holding and one is a chain holding. So I'm looking at, first of all, the first case when there is no chain. It says when investment in an associate or JV is held by a venture capital, mutual funds, and unit trust. So let's say A is the venture capital organization, or A is the mutual fund, or A is the unit trust. The investor himself, mind the words, the investor himself is supposed to be a venture capitalist organization or a mutual fund or a unit trust. In that particular case, he may elect to measure that investment at FVTPL in accordance with the financial instrument standard. Entity shall make this election separately for each associate or JV at initial recognition of the associate or JV. You need to basically decide an accounting policy that you want to measure the investments in such associates in accordance with 109, that is FPTPL, or you want to account under Ind AS 28, that is equity method. So the first case is if you are an investor. Now let's get the conditions parameters very clear. If you as an investor is supposed to be a venture capitalist, a mutual fund?
Sir, again, technical issue. Mm.
I hope it's working now.
Yes, sir.
I think it happens again. I'll have to restart my system, I guess. Okay. So this is getting too technical, I think, for my system to digest actually. But I hope, friends, you've got the inputs of what we are discussing in para 18. Okay, so let me just put the inputs again. As I said, if as an investor, now watch the conditions carefully for the para number 18. If as an investor, condition 1, you can say you are a venture capitalist or a mutual fund or a unit trust. The condition number 2 is that you've got a significant influence or a joint control over the investee. Then we can say once the two parameters are met, you get a choice either to account for the investments as per Ind AS 28 equity method, or you could consider FPTPL in accordance with Ind AS 109. Now let's go to the other case, that it is held indirectly. When it is held indirectly, then we are saying B is the venture capitalist or B is the mutual fund or the unit trust. Now, the second case of the para number 18 is putting the focus that A has got a control over an investee. Mind the words. A is got a control over the investee, where the investee is a venture capitalist or a mutual fund or a unit trust. And condition number 2, the investee is got a significant influence or joint control of C. So there is a chain. There is a chain in this particular case. So A is indirectly through B, who is a venture capitalist mutual fund, is got, let's say, an associate relationship or a joint venture relationship with C. A also again gets a choice. So either the investor himself is a mutual fund, a venture capitalist or unit trust, or his subsidiary is supposed to be a venture capitalist mutual fund. In both the cases, A will also get a choice either to consolidate C as per equity method 28, or we can say he can use Ind AS 109, that is FPTPL. I hope, friends, para number 18, both the cases are clear, right? I guess I'm clear on no chain holding as well as a chain holding, what parameters to be applied, when does A get a choice over B, or when does A get a choice over C. Are we clear, friends? So far, so good. Then I can go to the para number 19. Because as I move to para number 19, there will be slight little comparative analysis we need to make to 18 and 19. So far, so good. So in case number 2, choice will be given to A as well as to B. Well, in this particular case, if you're looking at B in C, I guess in case number 2, you're looking at B in C. So yes, it says when an investment in associate or JV is held by an entity which is a venture capital organization, yes, you can say even B gets a choice out here in this particular case. And of course, A also gets a choice in terms of C. You're right, absolutely. A as a investor is to consolidate B as well as to consolidate C. So he will also get a choice in terms of reflecting this investment, and B is similar to this point of the case itself. You're absolutely correct. Okay, now let's come on to the para number 19, where it says when an entity has got investment in an associate, can you see the word joint venture is nowhere given? The word joint venture is not given. Para number 17 was talking of associate JV. Para number 18 was talking in terms of associate JV, but para number 19 is talking only for an associate. It says a portion of which is held indirectly through a venture capital organization or a mutual fund or a trust. Now he is talking about an indirect portion. He is talking about an indirect portion. So let's take an example to understand the para number 19. Let's say it is A in B and B in C, and let's say A in C. So in order to get para number 19, let's look at this chain. So A has got a control over B, and B has got a significant influence. I did not say joint control. And A is also got a significant influence over C. I did not say joint control. So para number 19 is talking about only the presence of an associate, which is a significant influence. Now let's see. When an entity investment in an associate, a portion of is held indirectly. So we can say this is direct and this is indirect, and this is, I can say, direct plus indirect. Let's get this very clear. When you're looking at the para number 18, in para number 18, it is direct only or it is indirect only. But in terms of para number 19, it is direct indirect. So when we go to look at the case studies, I will very clearly pinpoint you that if it is direct, it is 18. If it is indirect, it is 18. But if you say it is direct, indirect, then it is para 19. Get this clear. Don't worry, we'll document that later. So it says that a portion of which is held indirectly. So a portion is held indirectly and there is a direct portion as well. It says in this particular case, entity may elect again an option to measure that portion. So that portion means the indirect portion. So you get an option to measure that portion only. So it says that portion of the investment at FPTPL 109, regardless of whether the venture capitalist organization has. Oh my God. Can you please give me a minute to, I think, restart my system, I guess. I think it'll create a problem. All right, I guess I'm clearly audible, visible, I guess. Thank you. Thank you. Okay, so let me just come back on the agenda. What I was giving you a distinction in terms of para number 18 and para 19. So there are two main differences in terms of para number 18 and 19. One of the differences which you can see in terms of para 18 and 19 is para 18 talks of a joint venture, para number 19 does not talk of a joint venture. So that is one clear-cut distinction, that para number 18 focuses on both significant influence and a joint control, and para number 19 is focusing only in terms of a significant influence. Second focus point is, when you look at the para number 18, it is talking of either a direct investment or it is indirect in nature. It's not a blend. It's not a blend. The para number 18 says that it is either directly held, case 1, or it is indirectly held, that is case 2. But when it comes to para number 19, it is talking of a blend, that you've got a direct investment also and you've got an indirect investment also. So get the two parameters very clear, the distinction in 18 and 19, which should be very crystal clear at the back of the minds. So when you look at the concept of para 18 and 19, if somebody says, give me the area of distinctions between the two, I would broadly tell him that para number 18 is focusing on significant influence and a joint control. But para number 19 is giving you clarification only on a significant influence. That's one. Second area of focus is that para number 18 talks of either a directly held investment, that means the investor is a VCO, etc., direct investment, or it is indirect investment, that through a VC or through a mutual fund, you've got an investment. So case 1 is direct, case 2 is indirect. So we can say no chain holding is direct, chain holding is indirect. But when you look at the concept of para number 19, it is direct, indirect both. So the investor is got direct share also, the investor is got indirect share also. I hope the distinction between the para number 18, 19, 100% clear. Okay, I'm getting a question. So what if, okay, I think Sana, you got a question. Let me just come back to your question. So you said that what if indirectly plus directly A gets enough shares that it results in a control and A will follow Ind AS to consolidate C? Well, in terms of para number 19, we are not looking at the combination where A in C plus B in C becomes a control. Then, of course, this para doesn't apply. So we're looking at a situation where A plus C plus B plus C is going to give you a significant influence only, not a case of control. Otherwise, yes, the para number 19 would not trigger in this particular case, right? I hope you got your answer on that. Okay, now let's come further out here and see what it adds on. Now it says, regardless of whether the venture capital organization has got a significant influence over that portion of the investment. He says, please do not worry if B in C has got no individual significant influence. What did he say? Regardless of the fact that that portion of the investment, so it does not make a difference whether B in C individually on a standalone has got a significant influence. What is important is A in C plus B in C put together is a significant influence. Whether B in C individually is a significant influence or not would not make a difference. I will still get the choice of recording A in C indirectly at FPTPL or equity method, and A in C, of course, is going to be equity method only. Then it says, if the entire entity makes that election, entity shall apply the equity method to any remaining portion. So A in C is the remaining portion. in an associate which is not held through a venture capital organizations, etc. So I guess now I am clear in terms of the inputs in para 17, 18, 19. Let me first document the inputs to you, and then we'll do some case studies based on these three para. So let me just first add on the inputs out here. So I am now looking at the cases of exemption. I'm looking at the cases of exemption. So when I say the cases of exemption, we're looking at the cases where you get a choice. So the cases of exemption means that we're looking at the cases where you get a choice, and that is under Ind AS 28. So I'm going to go one by one on each of these para number 17, 18, and 19. We're going to diagrammatically visualize the inputs, carefully see the distinction between these three paragraphs, and then we'll go to the case studies as well. So I would say the case number one. The case number one is the case of para number 17. And this would be a case where we say A, and then there is B, and then there is C, and then there is D. So this would be a case A is got in B, B is got in C, and B is got in D. So A has got a control on B, and B has got a control on C, and B has got a significant influence or a joint control on C. So this is the case when para number 17 would trigger. Now let's put the inputs out here. So we can say B applies. We can say B applies para number 4A of Ind AS 110. So para B applies the para number 4A of Ind AS 110, and we can say meets all four conditions. And it meets all four conditions. So you already know what are the four conditions which are there. So once B meets the conditions of para number 4A Ind AS 110, so what happens in this particular case? B is given a choice. B is given a choice not to consolidate. B is given a choice not to consolidate the subsidiary C. So B gets a choice not to consolidate subsidiary C. So we're looking at this particular chain that B gets a choice not to consolidate subsidiary C. Now if we come to this part, we can say Ind AS 28 para number 17. So Ind AS 28 para number 17 maintains same parity. It maintains a same parity out here as well. Now, what do I mean by that it maintains a same parity? It gives B a choice not to consolidate D as well. So in this particular case, the implication is B is given a choice. B is given a choice. So let's focus. This is also a choice. This is also a choice not to. And this is not to consolidate associate. Not to consolidate the associate D. So he gets a choice not to consolidate D as well. I hope, friends, para number 17 is 100% clear now. I've documented the inputs also very clear that if B is getting a choice under 110, he's given the same kind of a choice under Ind AS 28 as well. No consolidation of the subsidiary would also mean that you get no choice to consolidate the associate or the joint venture as well. Super. Now this was case number one. Now let's go to the case number two. Now let's have a look in terms of the case number two. Now in terms of case number two, we are looking at the para number 18 of Ind AS 28. Now we're looking in terms of para number 18 of Ind AS 28. Now comes two situations. So I'll write down the documentation of 18-19 comparison as well, but let's first focus on the para number 18. So in this particular case, the focus is there is a situation 1. The focus is there is a situation 1 and there is a situation 2. So when you look at the para number 18, your mind should immediately tell you that there are a total of 2 situations. When you look at the situation number 1, in this particular case, we're looking at direct. We're looking at directly held. And when you're looking at the situation number 2, we're looking at it is indirectly held. Then we're looking at the situation that it is indirectly held. So let's look at situation 1. A has got investment in B. So let's say A has got investment in B. Now, in this particular case, A has got a significant influence or a joint control over B. So there is significant influence or there is a joint control. So what we are saying further in terms of this is that A is a venture capitalist, a mutual fund, or a unit trust. I'm putting as VC, MF, and UT. So in this particular case, the investor A is supposed to be a venture capitalist, a mutual fund, or a unit trust. And he's got a significant influence or a joint control. So the standard very clearly says A gets a choice. Here again, A gets a choice, and the focus is he gets a choice not to. He gets a choice, rather, I will not say not to, I'll say A gets a choice. The choice is to apply. The choice in this particular case is to apply. So let me also tell you one thing very clear. Here the choice is to consolidate or not. Here the choice was to consolidate or not, but here the choice is either to apply equity method, either to apply the equity method as per 28, either to apply equity method as per Ind AS 28, or alternatively, you could measure the investment, or you could measure the investment at FVTPL. You could measure the investment at FVTPL, which is in accordance with Ind AS 109. So you're getting a choice in terms of taking this investment either as per equity method or to take it as 109. Now let's see the case which is there in terms of situation number 2. So this is, we can say, situation 1, there is no chain. And situation number 2, you're going to see that there is a chain. And in this case, we're looking at A in B and then B in C. So in this particular case, A in B and B in C. So A has got a control over B and B has got a significant influence or a joint control over C. That becomes indirect. This is indirect. And here again, we can say as far as B is concerned, it is a venture capitalist or a mutual fund or a unit trust. So you can see clearly in this case, A is the mutual fund venture capitalist. But in this case, the middle company B is the venture capitalist or the mutual fund. So in this particular case also, we can say who is getting a choice? A is getting a choice. So A gets a choice. Here also we are saying that A gets a choice. And the choice is, I would say, the same line. So let's put it like this. So A gets a choice. Either he applies equity method 28 or he measures at FVTPL the investment in C. A gets a choice to account for C as follows. Right, friends, I hope the para number 18 is also very clear. Direct, no chain, indirect, which is a chain, and who is the status and what kind of choices does A gets in this case. Right? Wonderful indeed. Now let's come to the case number 3. So now let's come to the case number 3, which is para number 19. So now we come to the case number 3, which is a case of para number 19. And this is again Ind AS 28. We're looking at para number 19 of Ind AS 28. Now, before this, I think I'd like to make a clear-cut distinction between the two inputs comparatives of 18 and 19 as well. So on the side, let's also put down what is the difference between the para number 18 and what is the difference in terms of para number 19. So we get a clear-cut distinction between the difference in the case 2 and the case number 3. So first of all, in terms of para number 18, there is either a signet influence or a joint control. But in terms of para number 19, there is signet influence only. No inputs are given as far as a joint control is concerned. Secondly, if we look at para number 18, it talks of direct, it talks of directly held, and it talks of indirectly held. So it is either of the two. It says it is either direct or it says it is either indirect. But when it comes to para number 19, it is direct plus indirect held. So it is directly plus indirectly both. So it talks of the combo offer in this particular case. So this is either a direct or an indirect, but that's direct plus indirect both put together. So I guess now we can make the chain in this case. Let's say we've got A, we've got B, and we've got C. So A is got in terms of B, B is got in C, and A is also got in C. So there has to be a chain again, which means in terms of para number 19 also, there is supposed to be a chain as well. So para number 18, case 1 would be no chain. Para number 18, case 2 will be a chain. Para number 19 would be definitely a chain because in this case, direct and indirect is there. So chain will be same. So this is a control and this is, let's put it like this. Let's put it an asterisk out here. So we can say A in C plus B in C put together is supposed to be a signet influence. So what is important is that A in C as well as B in C put together is signet influence. Individually, whether there is a signet influence, whether there is a signet influence or not, does not make a difference. It does not make a difference. So in this particular case, the clarification is very clear. It is not necessary that A in C individually is significant influence. B in C individually is a significant influence. Put together, there should be significant influence. So it can be 10 plus 10. It's fine. It can be 20 plus 10. It can be 10 plus 20. Doesn't make a difference at all. So what is important is that put together, there is 20% or more. Individually, it may not be, does not make a difference. So now let's see in this particular case, who is supposed to be the venture capitalist? So B is a venture capitalist or a mutual fund or a unit trust in this case. Now we need to consider that there are two portions of the investment in C, A in C direct and A in C indirect. So there are two inputs which are given very clear. So we can say there is investment A in C that is direct. And then there is A in C which is indirect through B. So this is the two portions. You can say this is the two portions of the investment. This is the two portions of the investments in this particular case. So when you say A in C direct, in this particular case, we can say equity method is mandatory. In this particular case, we can say the equity method is mandatory. So for this particular portion, you have to apply an equity method irrespective of the percentage. Mind you, irrespective of the percentage. And when you say A in C, then we can say A gets a choice. A gets a choice. Either we apply equity method Either we apply equity method as per Ind AS 28, or we consider FVTPL, or we consider fair value through P&L, which is as per Ind AS 109. I hope now the position is absolutely clear in terms of all para 17, 18 and 19. You know what is the distinctions out here. So I have documented every bit of this paras to you, and now I think we're ready to do some case studies with you. So I think the system has also got settled on this area now. No complications system, hopefully. Okay, wonderful indeed. Now I think let's do some case studies, friends, with you on this area. So I have taken a few questions from the study material as well as a few questions which are taken from the education material as well. So I guess let's first have a look in terms of, I guess, an easier question to go with. Let's first look at the question which came in the RTP. This question is there in the RTP as well. So I will just, I think, go case by case. Though I've written application of para 18 and 19, but technically if you ask me, why should I tell you in advance it is 18, 19? I think I should ask you, is it 18 or 19? Let's read. It says an entity P is a parent, is got two wholly owned subsidiaries, that is X and Y, each of which has got an ownership interest in an associate entity Z. I think let's make a diagram as well to visualize the input simultaneously. So we're given that there is a company P, it has got two wholly owned subsidiaries X and Y. So it has got two wholly owned subsidiary X and Y. Rather, let me just make it not on this style. Let's draw the line like this so that we can clearly see the inputs. So it says P has got two wholly owned subsidiary X and Y. So there is 100% stake control. There is 100% stake, that is control. Then he says each of which has got ownership interest in the associate. So both have got an ownership interest in an associate Z. But what is the percentage is not given as of now. So we are given that P is the parent and then X and Y are the subsidiary and Z is an associate. Subsidiary X is a venture capital organization. So we are very clearly given that subsidiary X, the inputs which is given is regard the subsidiary X. This subsidiary X is a venture capitalist. That is what is given. That X is supposed to be a venture capital organization. Neither of these investments in associate Z by subsidiary X and Y is held for trading. So he's very clearly says that these investments are not held for trading. So don't apply directly Ind AS 109 that take them at FVTPL. Subsidiary X and Y account for their investments in Z at FVTPL in accordance with Ind AS 109 and using the equity method in accordance with Ind AS 28. So what X does in its standalone financials, it applies 109 FVTPL and in the consolidation equity method. And same is what Y is doing. So right now, X and Y both are consolidating as per 28 in the console and FVTPL in the standalone statements. How should P account for the investment in Z? How should P account for the investment in Z? He's asking you the accounting of P in Z. He's asking you the accounting of P in Z. Now, let's go ahead. Before I come to the scenarios, I think I want your inputs in this particular case. Is it para number 18? Is it para number 19? Or is it para 18 plus 19? Let's get the inputs on your side. I think I've already got the answers from your side that this is para 18. Think. Is it a case of para number 18 or a para number 19? Or is it supposed to be a case of 18 plus 19 both put together? Think and answer. You need to visualize carefully that P's investment in Z is routed through X and also routed through Y as well. It's routed through X, it is routed through Y. It is, two portions of the investment. So we can say one portion of the investment and another portions of the investments in this case. I would say indirectly this is para number 19 only, though you can have some essence of para number 18, but it's typically para number 19. Because we can see that there is an indirect percentage out here, though it is not direct, it is again indirect in nature. Now, since you would say that it is indirect, it should be 18. But there is a portion which is indirectly through a venture capitalist. There is a portion which is indirectly through a venture capitalist. So I would say to this particular portion which is through is supposed to be para number 19. And I would say this can be interpreted as para number 18. So to me, I think it's 18 and 19 put together. The para number is not that relevant. Now, let's see further. I am just thinking before even I read the question, scenario A123, let me just pinpoint something. I'm looking at the investment P in Z, which is through X, And I'm also looking at investment of P in Z, which is through Y. So there are two portions of the investment. One is through X and one is through Y. Now let me say something, vouch me. Can I say this portion of the investment which is held through a venture capitalist, the company P should get a choice of 28 and 109. So my mind tells me that this portion P should get a choice. Either he wants to apply Ind AS 28 or he wants to apply Ind AS 109. He should get a choice by virtue of para number 19. So since P is having 100% control over Y, it'll be considered as a direct control. That's right. So we can also say that this is again through subsidiary and this is through subsidiary. Correct. So I guess if I look at P in Z, I would outrightly say that P in Z is an application of para number 19. And in terms of para number 19, since this is through a venture capitalist, he should get a choice. But when you look at P in Z, I think in this particular case, it is indirect, but since in between there is no venture capitalist, he does not get a choice. He has to apply Ind AS 28 itself. Agreed, friends, on that? I've not even read the scenario 1 to 3. I'm just looking at the interpretation that in this particular case, for this portion, we get the benefits under choice 28109. And for this particular portion, it would be simply Ind AS 28 for console point of view. Correct. Now let's come to the scenario 1, scenario 2, and scenario 3. Where both investments in associate result in a significant influence. Subsidy X and Y in Z is 25% and 20%. This is 25 and this is 20. Individual levels, there is a significant influence. We decided that X in Z plus Y in Z individually may not be a significant influence. What is important is put together, this and this portion put together should be SI. So as it is individually, there is a significant influence. I'm okay. The answer remains the same. When neither of the investments in associate results in a significant influence, but do provide the parent with a significant influence on a combined basis. X and Y each has got a 10% stake. It doesn't make a difference to my analysis again. If it is 10 plus 10, it makes it a total of 20 because 100% of 10 is 10, 100% of 10 is 10. But even for the application of deciding whether I am under the purview of this standard, I'll take 10 plus 10. So in this case also, the same answer would remain valid. Because individually there may not be a significant influence. It doesn't make a difference to me. What is important is combined basis, there should be a significant influence. Then he says that one of the investments results in a significant influence on a standalone and the other investment does not result in a significant influence on a standalone. There is 30% and 10%. then also it doesn't make a difference to me. If it is 20 plus 25, it's okay. 10 plus 10, it's okay. 30 plus 10, it's okay. At the end, what is important is put together on a combined basis, there should be significant influence. Standalone, there is significant influence or not. One is there, other is not, doesn't make a difference to me. Scenario 1 to 3 is just a clarification. What is given in para number 19, that it does not make any difference at all. Okay, so I think in this particular case, we can conclude what we concluded at the initial is absolutely correct. Whether you give me 3 different scenarios, my analysis would remain the same, that this particular portion which is through a VC, para 19 choice, and this is not through a VC, so you can say equity method becomes mandatory in nature. Super. Let's, I think, go now to another interesting question. So we're going to first look at an example out here. Let me just edit this out, fit into the page. So let's have a look in terms of 2 different examples now. Let's first look at the example which is on the top. Rather, I think let's first look at down, maybe. Okay, let's first look at the second example, then we come to the first example, because the first example is super duper. It's from the educational material. Let's first look at the below one. It says ABC operates a pharmaceutical business and owns a venture capital organization that is subsidiary B. So we can see that this is a venture capital organization. I'm looking at this chain. I'm looking at this chain. That is one. And I'm looking at this. Technically speaking, I would, make the diagram look a little better so that you can get a feel. And I would say it is subsidiary B, and I would say it is Z, and it looks like this. I think that will give us a better feel of what I want to show you. So we can see that ABC is got direct and ABC is got indirect. So I think with this kind of a positioning, you'll see things better. What is the para number coming to your mind? When you're saying that this is a venture capital organization, what is the application, the para number coming into your mind? That's rightly said, para 19. It is a clear-cut case of, you can say, a direct and indirect. So I think before even I read the question, I would say that this is directly held, equity method. This is indirectly held. You get a choice of 28 and 109. Let's read. It says ABC operates a pharmaceutical business that invests in construction industry. V's business is monitored on the basis of fair value investment. ABC and V has got 20% shares each in Z. So there is a 20%, there is a 20%, and this is supposed to be a case of control. It's a subsidiary. How shall ABC account for the investment directly and indirectly through V in the investee Z in the consolidated financials? I think we've already said that. I'll just quickly document this part to you. So we can say, if you look at the portions ABC in Z, and you look at ABC in Z, this is direct and this is indirect. So there are 2 portions of the investments, direct as well as indirect. So for direct portion, you need to apply Ind AS 28. Equity method becomes mandatory. And for the indirect percentage, you get a choice. Either you apply the equity method or you consider FPTPL as per 109, you get a choice. Right, so I think that was also a simple and a straight example indeed. Now, friends, comes the interesting example. We've understood the application of 1819. We want to see something now very interesting coming in. Let's go back to the first example on the top of the page. Following is the group structure. ABC is an investment entity and also a VCO. When you are an investment entity, it reminds me the para number 4B of Ind AS 110. And let me tell you that when you look at the para number 4B of Ind AS 110, it is something which is mandatory in nature. Where if you're an investment entity and you fulfill my three-step model, in those particular cases, you cannot consolidate. The interesting part is the para number 4E is a choice, 110. The para number 18, 19 and the para number 17, they're all choices. If you look at 110, para 4A is choice, para 4B mandatory. If you look at Ind AS 28, the para number 17, 18, 19, all choice. Let's read further. So ABC is an investment entity and a venture capital organization. AB is a non-investment entity. PQ is a non-investment entity. This is a subsidiary and this is an associate. Wow. I'd like to get your inputs on the site. It says ABC is a venture capital organization and fulfills the definitions of investment entity under 110. How should ABC account for the investment in AB and PQ in its financial statements under 110 and 28? So this is a subsidiary, so you need to evaluate 110. This is an associate, so you need to evaluate Ind AS 28. So the question rises, what would you do? So in this particular case, you need to decide. I'm getting the answers for the direct method equity. For the indirect, you get a choice. Now, please hear me carefully. I'll give you some very interesting inputs at this stage. When you're looking at ABC is supposed to be an investment entity. When you say that ABC is an investment entity, there is no chain. There is no chain. So in this particular case, do we need to apply a three-step model, or can I outrightly say that you get a mandate not to consolidate? My question very carefully. I'm saying that this is not a chain. Looking at ABC in AB, it's not a chain. So can I outrightly give ABC and tell him as a mandate that you cannot consolidate because you are an investment entity? Am I right? Am I right as per Ind AS 110? Because the three-step model applies when there is a chain holding. It was 4B read with para number 31, 32. But this is not a case of 31, 32 where you are given that there is a chain in this particular case. Investment entity per se gets a choice in this case, right? Now, if you look at ABC's status as an investment entity, he is mandated not to consolidate. He is mandated not to consolidate. Is Ind AS 28 talking of an investment entity? No, it's talking of a venture capitalist, a mutual fund, or unit trust. So for this particular portion, you can apply Ind AS 110 and it mandates that you cannot consolidate. But when you look at this particular portion as a venture capitalist organization, in this particular case, the para number 18 of Ind AS 28 gives you a choice that you may not consolidate. But there is a problem. Now see the problem. I'm telling this company that your subsidy will not be consolidated, and I'm telling this company under Ind AS 28, you've got a choice to consolidate. But the problem is, if you look at Ind AS 110 and you want to look at the status of an investment entity, the investment entity has to measure all its investments. The investment entity is to measure all its investments at FPTPL. All means all. So that means if you want to call this as an investment entity, it has to measure all the investments in accordance with FPTPL. So Ind AS 110 mandates an investment entity to to measure all the investments at FPTPL. So Ind AS 110 will override Ind AS 28 in this particular case. Even though the para number 18 gives a choice to this company under Ind AS 28, Ind AS 110, para number 27, if I'm not wrong, mandates that this investment entity has to measure the investments at FPTPL. So in this particular case, Ind AS 110 para 27 will override the para number 18 of Ind AS 28 and he will not be able to consolidate. So para number 18, which is optional, becomes mandatory in such a situation. So once again, and so please document this as well. No worries, I'll document this as well. But this is a beautiful clarification. I'll put this once again to you. I think let me pen this down and let's make separate notes on this area to give you a clarity of thoughts. This is a beautiful clarification. So I'll put this like a clarification itself. So do you remember this? Because if you get such a question in the exam, I think somebody who's done this question earlier can only do this. If you have not done this question, then I see that there could be difficult chances. So moral of the story, there is a company A and there is a company B and there is a company C. Company A is an investment entity and company A is also a venture capital organization. So it's like A is an investment entity and a venture capital organization. So I'm looking at A in B, I'm looking at A in C. So this is a control and this is a case of a significant influence. Now in this particular case, let's go with first of all the inputs A and B. Let's go with A and B. So when you look at the concept of A and B, we can say para 4B of Ind AS 110. Para 4B of Ind AS 110 mandates. So this mandates that A cannot consolidate. It mandates that A cannot consolidate B. So it says that you cannot consolidate B. So this is the status of A and B, that para number 4B of Ind AS 110 tells a boss you cannot consolidate. A and B is measured at FPTPL as per Ind AS 109. So you will have to apply the concept of FPTPL as per Ind AS 109. Now let's come to the status of the other company, that is A and C. So as far as A and C is concerned, what I need to do, since it is significant influence, I'm looking at para number 18. So I'm looking at the para number 18 of Ind AS 28. So I'm looking at the concept of para number 18 of Ind AS 28 gives a choice. It gives a choice. So this is not mandate. It gives a choice to use either equity method or FPTPL. To use either equity method or FPTPL. So the choice is there that you use either equity method or FPTPL. It's a choice. But there is a problem. However, so we can say in this particular case, however, if A wants to be treated as an investment entity, if A wants to be treated, so this is like point 1 you tell the examiner, this is like point 2 you tell the examiner, and this is the point number 3 which you tell the examiner. So he says if A wants to be treated as an investment entity as per Ind AS 110. So if he wants to be treated as an investment entity as per Ind AS 110, then there is a para number 27 of Ind AS 110. You need not remember the para numbers. This is just to give you for a reference. So we are saying in this particular case, para number 27 of Ind AS 110 mandates that A has to account all investments. It is supposed to account all investments at FPTPL. It has to account all the investments at FPTPL. So which means he has to account for A and B, A and C, both at FPTPL on a mandatory basis. So moral of the story, therefore we can say the moral of the story. So based on this, the moral of the story in this particular case is what? So we can say the moral of the story is that Ind AS 110, that is para number 27, will supposed to override, you can say the para number 18 of Ind AS 128. So in this particular case, the para number the Ind AS 110 will override the para number 18 of Ind AS 28. Thus, A will measure both investments. A will measure both investments. So when I say both investments, of course, A and B, A and C. So thus A will measure both investments, that is A and B and A and C at FPTPL. So this will be mandated for them and they'll have to measure the investments at an FPTPL in this case. This is superb. If you ask me, this is absolutely superb kind of a clarification which is given in the education material. The example which I did is based on the education material itself. So A will show investments, you said, in separate financials, right? As mandated not to prepare console. Yes. Because A in this case will not be making a console, and you're right that A in the separate financials will be reflecting this investments at FPTPL. That's right. Right, friends. So I think this completes my concept of block 1 scope, not the entire block. So we're done with the first area, that is the concept of the scope or the standard. I've given you detailed analysis of para 17, 18, 19 and the interaction of 110 with Ind AS 28. Now comes the lighter part. The tougher part is done. Now comes the lighter part. Now I need to take you to the concept of significant influence. How do you evaluate the significant influence? So I think what I'm going to do, first of all, I am going to give you some inputs on this. Let's now come to the second area of discussions in the block number 1, which is the assessment of a significant influence. So we're now working on the area that how do you assess a significant influence? I've already given you the basic presumption of the 20% or more, and if it is less, but then there are certain other factors which needs to be evaluated in this case. Now, before we look at the illustration 1, I want to have a look in terms of the judgment. It says judgment required in assessment of significant influence. The standard has given us some parameters that you need to look into some other parameters apart from the voting power percentage to make an assessment whether significant influence is there or not. So let's look at those parameters. It says the assessment of whether investor is got a significant influence over the investee involves an application of judgment. In making such a judgment, the investor shall consider the following factors which generally demonstrate the existence of a significant influence. Representation on the board of directors or an equivalent governing body. Remember the case of Ind AS 110 when you said that you've got less than majority voting power, then you start looking into other parameters like contractual arrangement, representation on the board of directors, etc. Similar kind of thought processes are applied in this Ind AS as well. So if you've got generally, I would say these parameters generally would trigger in a situation where you've got less than voting power, 20% less than voting power, you'll see, okay, as an investor, do you got a representation on the board of directors? So if you've got a representation on the board of directors, maybe, I'm not saying confirmed, maybe, you can get a significant influence as well. It can be judgmental, but we are saying you may be. So in a situation where the investor gets less than 20, but there is a representation on board of directors, we can say maybe there could be a significant influence considering the combo. Let's see. It says Cuckoo has got 12% voting shares in Boho, which is below 20. Boho board is comprising of 8 members and 2 of which are appointed by Cuckoo, and each board member has 1 vote in the meeting. Now, I guess if you look at that, every person has got 1 vote. If out of 8 directors, I can appoint 2 directors, which means I've got a 25% representation on the board. So since the decisions are taken, let's say, on the basis of not the concept of voting power, but on the basis of the board of director representation, 2 out of 8 makes it 25. So I think that should give a significant influence. Boho is an associate of Cuckoo, as a significant influence is demonstrated by the presence of directors on the board and the relative voting rights at the meeting. So then he's just mentioned about that journal part. So we can say, yes, since in this particular case, your representation on the board of directors entitles you to indirectly a 25% voting rights, you get a significant influence. Second condition, it says participation in the policy making process, including participations in decisions about dividends or distributions. Generally, when you look at the concept of control, the parent company generally has a power to take decisions on dividend. But in terms of associate, this is sometimes lacking. But as an investor, if you are involved, you're participating in the policy making, especially when you've got a participatory role in terms of dividend distributions, you can get a significant influence. M got a 10% voting power, and the balance 90% is held by 9 other investors. Each has got 10%. So everybody's got 10, 10, 10, 10, 10. There are 10 investors with 10% each. The decisions about relevant activities, except decisions about taking borrowings of the investee, are taken with the members holding majority of the voting power. The decisions about borrowings are required to be taken by a unanimous consent of all the investors. And further, decisions about taking borrowings are not the decisions that most significantly affect the returns of the investee. Does M got a significant influence or not? So in this particular case, there is a participation in terms of the decision-making process. M is holding less than 20%. M's consent is required to take decisions about taking borrowings, which is one of the relevant activities. Further, since decisions about borrowings are not the decisions that most significantly affect the returns, it cannot be said that all investors have a joint control over the investee. So in this particular case, agreed a unanimous consent is required in terms of borrowings. But then this is not the most significant activity. So we said in terms of Ind AS 110, when you're looking at a joint control, the activities should be something which is relevant. If you've got plethora of activities which are relevant, you need to see which one is most significant in nature. It says a unanimous consent is required for the borrowings, but then this is not the most significant one. So it can be said that M has got a significant influence over the investee. So the first one is a participation, a representation in the board of directors. The second is a participation in the policy making process, especially in terms of dividend distributions. Next, we're given another parameter in the standard, and that is material transactions between the investee and the investor. So if you can notice that there are some material transactions between the investor investee, there could be a possibility of a significant influence even if you got below 20%. RS is an entity engaged in business of pharmaceutical. It is invested in the capital and has got a 15% stake in voting power, below 20%. XY is engaged in the business of producing packing material. One of the incentives of RS is to invest in XY. The fact that XY is engaged in the business of providing packing material, which is also useful for RS. Since many years, XY almost has got 90% output procured by RS. If 90% output is procured by the investor, it indicates a materiality level of transaction between the investor-investee. And I think it will certainly indicate that there is a significant influence. I will not like to talk in terms of control, because with a 10% stake and this kind of a decision, it's difficult to prove a control, but at least significant influence can come. Since 90% output is procured by the investor, XYZ would be dependent on RS for the continuation of its business. Hence, RS is holding only 15%, it can get a significant influence. So you need to watch out that these are all judgmental cases. There is no yes and no, black and white. It is all subjective. You see that you've got representation on the board of directors. You see that there are material transactions between investor-investee. You've got a participation in the policy-making process, especially dividend distributions. There could be a possibility of a significant influence. There is more factors given. So he will show investments in, okay, that was the previous one. Okay. Then the next condition is interchange of managerial personnel. You've got interchange of managerial personnel, that could be another indicator. Entity X and Y operate in the same industry but in different geographical region. X acquires a 10% stake in Y as a part of the strategic investment. A new production process is the key to serve a fundamental change in the strategic direction of Y. The terms of the agreement provide for entity Y to start a new production process under the supervision of two managers from entity X. The managers are seconded from entity X. One is on the board of X, who will oversee the selection and recruitment of the new staff, the purchase of the new equipment, the training of the workforce, and negotiations of the new purchase contract for raw material. The two managers will report directly to entity Y board as well as to the entity X. You've got common people overlooking the things in the organization. So interchange a managerial personnel. So they are also managerial personnel in the investor and the managerial person in the investee. This could indicate, I'm not saying always, judgmental. The secondment of the board member and the senior manager from X to Y gives X a range of power over the new production process, evidence of a significant influence. The assessment takes into account what are the key financial and operating policies of X. When you are having an interchange of managerial personnel, the significant influence indicates that you are able to participate in the financial and operating policy decisions of the investee. And if you're looking at participation in the operating and financial policy decision with this kind of interchange of managerial personnel, I think the role of participation in the financial operating policy gets further strengthened, indicating significant influence. And last but not the least, there is another input also which is given, and that it says provision for essential technical information. So provision of essential technical information. As an investor, I am providing something, which is essential. That gives me, the significant influence over the investee as well. R is a tire manufacturing entity. They entered into a technology transfer agreement with entity Y, which is also involved in the business of tire. So technology transfer is like providing essential technical information. R is an established entity in the business, whereas Y is relatively a new entity. As per the agreement, R is granted to Y a license to use technical information and know-how which are related to the process of manufacturing tires. Y is dependent on the technical information and know-how because of the lack of expertise and experience in the business. The investment R made in the capital Y is only 10%. Now, because of the fact that there is an essential technical information, dependency creates that kind of influence. So in this particular case, R has got a significant influence despite only a 10% equity. So moral of the story. What we're looking at in terms of the significant influence is 5 broad parameters apart from a percentage. We're looking at representation on the board of director. We're looking at providing essential technical information. We're looking at interchange of managerial personnel. We're looking at a participation in the policy making, especially the dividend decisions. And I think another fifth condition which I gave you was in terms of material transactions between investor-investee. So these 5 broad inputs could, indicate that even if you've got less than 20% voting power, you can still get a significant influence as well. Before I document all this out, I want to go back to the illustration number 1 as well, which is also indicating that you've got now more than 20%, but you still may not get a significant influence as well. So let's also have a look at a reverse case. We've seen cases where you've got less than 20, but still a significant influence. We want to also look at a case where you've got more than 20, but there is no significant influence in that case. Let's look at illustration 1. E has got a 25% voting power, which means on a very apparent front, you've got a significant influence in this case. The balance 75% is held by 3 other investors, each holding 25%. Now, at this stage, let me also clarify something. If, let's say, one investor gets a control over the investee, it doesn't mean that another investor cannot get a significant influence. If, let's say, 2 or more than 2 investors have got a joint control over the investee, it does not mean that another investor cannot get a significant influence, because the possibility is that somebody gets a control, another person gets a significant influence. 2 or more investors get a joint control and some other investor gets a significant influence. So the presence of a control by other people, the presence of a joint control by other people does not preclude that I cannot get a significant influence. So even if you're trying to watch out that these 3 investors put together could have got a joint control, it doesn't mean that I cannot get a significant influence. It says the decisions about financing and operating policies are taken by investors holding majority voting power. Since the other 3 investors hold a majority voting power, they generally take decisions without taking the consent of E. Even if E proposes any changes to the financial and operating policies, the other 3 investors do not vote in favor of these changes. Poor fellow E. He says, I want these changes ignored. And they conduct meetings and they've got majority. So in effect, the suggestions of E are not considered while taking decisions, determine whether E has got a significant influence or not. I think he's a paper investor. An investor who's got a 25% stake on the paper, but nobody listens to him. When the meetings are conducted, they conduct the meetings without his approval. And when he says changes, nobody gives him any kind of, his suggestions are ignored. So he's more like a paper investor. Since he's got more than 20, it indicates he might have a significant influence. However, the other investors prevent him from participation of financing and operating policy decision, and therefore he is not in a position to exercise any kind of significant influence. So percentage is not a criteria. Looking at the facts and circumstances of the case, it can always get challenged as well. Okay, now I think let's document this bit as well. So let me put this across. So I think let's make some quick notes on the assessment of significant influence. So this is the block number 1, scope is done, and this is on assessment of significant influence. So let's make some notes on the concept of assessment of significant influence. I'll divide the discussions in 2 different broad parts. So let's divide the discussions in 2 broad parts. So I would say there are 2 cases. One is that we're looking at that there is a 20% or more voting power. But in this case also we can say the facts and circumstances are to be evaluated. So the facts and circumstances needs to be evaluated. because we cannot go with the fact that there is a paper percentage, just like we saw in terms of illustration 1. So when you're looking at that, you've got 20% or more than 20% voting power, that could be a paper percentage. So facts and circumstances need to be evaluated. We saw this in terms of illustration 1. The second situation we're looking at is that you've got below 20% voting power. In this particular case, we need to again apply judgment. In this particular case, we again need to apply judgment. We need to see other factors as well. And we have a list of 5 factors to be evaluated in this case. So in this particular case, we need to apply judgment based on the 5 factors which are given in the standard. I'm just going to put some keywords in terms of what judgmental factors do you need to apply. So I would say the judgmental factor number 1 is, we're looking at, for example, I'm just putting it in any order, material transactions. There is material transactions. So there are material transactions between investor and investee. So there are material transactions between investor and investee. So what is important is the word material transactions. You need to apply judgment on that. Representation on board of directors. There is a representation on board of directors. So you are got a representation on the board of director. There could be a provision of technical information. Provision of some essential technical information. So if you are providing some form of a technical information, so provision of that essential technical information could be a deciding factor. There could be interchange of managerial personnel. There could be interchange of managerial personnel as well. So if there is interchange of managerial personnel, that could also be an indicative factor. And most importantly, participation. So let's put it out here. There is participation in policy making. There is participation in policy making process. So there is a participation in the policy making process. Typically, when you're looking at this, typically dividend decisions. You can say typically it would be dividend decisions. You're able to participate in the dividend decisions, that could be indicative as well. And all the illustrations, just to map this out, illustration number 2 to, I guess, illustration 6. So here you can see the mapping in terms of illustration number 2 to illustration 6 is all based on these fundamentals. I think that gives us a clarity of thoughts. So we get the entire inputs, that when you're looking at a significant influence, you need to watch out that generally if it is 20% or more, it indicates that there will be a significant influence, but you need to still look at the facts. Even if it is below 20%, you cannot say that there is no significant influence. You need to apply the parameters, the 5 parameters which are given in the standard. Right, friends, so far so good. I guess my block number 1 is done at this stage. I am done with the concept of the scope in terms of para 17, 18, 19, and also in terms of the assessment of significant influence. Now we're left with 2 more blocks. Just to remind you today again, I am going to take a little extended class today as I had requested earlier. So we're going to give you a break now. I think at this particular stage, we are going to extend the class till around 10:30 to compensate for the shorter class on Sunday, as we said. So we've got 2 more agendas. One is pretty okay. The next agenda, that is the 3rd block, is slightly technical in nature, but very interesting indeed. So before we go to the block number 2, which is in terms of accounting, let's first give you a break. Let's take a 12 minutes break or so, because you've got a long time to go. So I think I'm going to give you around a 12 minutes break and join you after the break for the 2nd block. Enjoy your break. Okay, thank you. core accounting part of this Ind AS, and that is in terms of equity method of consolidation. I gave you a bit flavor of the equity method earlier as well, but now we're going to talk a little more detail on how the equity method of consolidation is applied. So let's understand the block number 2, which is dealing with the concept of accounting. That is the equity method of consolidation. And this equity method of consolidation is what is applied in a consolidated financial statements. As I said earlier, it is called a one-line consolidation. Let's take a very basic example to understand the first very basics of this particular method. Then we'll get into a little technicality. But let's begin with a very simple example. Let's say consider that there is a company A which has got in terms of B, let's say a 25% stake. I presume that there is a significant influence and there is nothing to the contrary. Now, let's say this investment is purchased at a cost of, let's say to the tune of, let's consider 4 lakhs. Now, on the date of acquisition, let's say when this 25% stake is acquired, let's say on this particular date, the net assets at fair value of company B is concerned, let's say it is to the extent of, let's assume a figure to the extent of, let's say, I'll just take an arbitrary figure to get it correct. Let's consider the net assets is 15 lakhs. So let's consider the fair value is supposed to be 15 lakhs on this date. Now, we can see that A acquired the investment at 4 lakh rupees, whereas the net assets at a fair value on the date of acquisition is 15 lakh. So let's see what is the premium which he paid. Just do the ordinary calculations which you do to calculate a goodwill. So I can say he paid a total of 4 lakh rupees versus out of 15 lakhs, he gets a 25% stake in the company that comes to 3.75 lakhs. So we can definitely say that in this case, the difference 0.25 lakhs is nothing, but we can say it is supposed to be the premium, which is the goodwill in this particular case. You know, if somebody were to ask me to make a consolidated balance sheet on this very date itself, that means I'm looking at the accounting on the acquisition date itself. So let's assume that if I were to do the accounting on the acquisition date, let's make a T-shaped balance sheet. So if I were to make an investment in the consolidated balance sheet, this investment will appear at 4 lakh rupees in the outer column. So, but that is the cost of acquisition. Yes. Trust me, on the date of acquisition, whether you are going to look at the separate financial statements of the investor or the consolidated financials of the investor, you're going to see the same value. So this is the consolidated balance sheet of the investor. In the inner column, you will disclose that there is a goodwill as a part of the carrying value of the investment. So when you are calculating the investment from a consolidation point of view, goodwill is not reflected as a separate line item. The goodwill is reflected as a part of the carrying value of the investment. So on the date of acquisition, your separate financials will also show 4 lakh. Your consolidated financial statements will also show 4 lakhs, except that you'll make a disclosure of this goodwill. So this is only a disclosure. It is disclosed as a part of the carrying amount of investment. It is not a separate line item. It is not a separate line item. The goodwill does not appear as a separate line item in the consolidated balance sheet. So this entire accounting is what I can say is the case of initial recognition. This is, I would say, the stage 1, which is the initial recognition. need to do, I just need to compare the cost of the investment versus the net assets at a fair value, the share in the net assets at a fair value, and you get the amount of goodwill. Oh my God. Today, I think it seems to be a very jinxed kind of a day. Okay, I hope it continues good. So in this particular case, when you're looking at the investment in an associate, you are going to show the investment as a one-liner. As a one-liner in the balance sheet, no aggregation of assets, no aggregations of liability. And that also reminds me, today I need to give you an interesting chart towards the end. Please remind me at the end, once I'm done with this particular standard, that I need to give you a chart which is on a stock reserve, upstream, downstream, balance sheet, P&L. I think I promised for that. It's my constructive obligation to do so. So if I forget, you can ask for me in the end. Okay, so this is on the initial recognition. Now comes the stage number 2, which can be called as a post-acquisition changes. That can be called as a post-acquisition changes. Now comes the interesting fact as far as post-acquisition changes are concerned. I always tell people that when you were in foundation, you used to calculate, you used to apply the concept of a bank reconciliation statement, and your two hands were supposed to be, one is a cash book and the other is a passbook. And I tell people, that when you went to the intermediate stage, in that particular stage, you learned the concept of reconciliation of cost and financial accounts in CMA, in cost and management accounting. And one was supposed to be financial accounts and one is the cost accounting. At every stage, we've got to make use of the hands. Now you're in final, so we're going to make use of the hands again in terms of accounting for equity method. Just like a bank reconciliation, just like a reconciliation of cost and financial accounts, you would apply the same concept out here in terms of equity method. So watch this carefully. Watch this carefully. I think I gave you a basic feel earlier as well, but watch this carefully. The idea is, rather, let me also say something which I'll connect you back again. If somebody were to ask me, that what is the value at which an investment appears under equity method, I would say it basically appears at the share in net assets, that is 375, and plus the amount of goodwill. And trust me, at any stage, at any point of time, you want to basically, reconcile the value of the investment in the console. Trust me, calculate the net assets of the associate company, take your share, and add the goodwill. Your investments will match with that figure. At any point of time, you want to make a reconciliation that what is the investment in the associate, calculate the net assets of the associate on that date, take the share in the net assets, add a goodwill, and you'll match up with the figure of investment. So which means the standard is working on the concept. And if you remember, even in Ind AS 110, if you remember when I gave you the very basic concept of consolidation, I said the investment gets replaced by the 100% net assets plus a goodwill and NCI, which is indirectly a share in the net assets plus goodwill. The essence of consolidations is all the same, except that in Ind AS 110, you do a full consolidation and then you show the NCI. So basically, you're consolidating the share in the net assets and you're also reflecting the goodwill. In terms of Ind AS 28, you're not doing an asset liability consolidation, but you show the investment at a single figure, which is the share in the net assets and goodwill. So what we need to do when you're making this equity method, I would say the easiest task to visualize is, let's say one hand is the net assets of the associate, and let's say the other hand is the investment. Now, what you need to do in a post-acquisition movement is you need to track the net assets of the associate. Hear me carefully. You need to track the net assets of the associate. If the net assets of the associate goes up, you need to increase the investment, but not by the increase in net assets, share in the increase. So you need to keep a tracking in the sense that if the net assets of the associate goes up, you need to also increase the investment by the share in that increase. If the net asset goes down, you need to bring down the investment as well to the extent of share in the decrease. A continuous tracking needs to be done. Every time the net assets of the asset pushes up, investment up by the share. The net asset pushes down, investment down by the share in the net assets. But this is only the movement of the investment. There has to be a double effect bookkeeping as well. So what we need to do in a post-acquisition changes is you need to consider the two factors. You need to consider the net assets of the associate on one hand, track the changes in the net assets of the associate, and accordingly we will take the impact on investment. So continuously keep a tracking, which means if the net asset increases, you need to basically increase the investment. When I say increase the investment, it means you need to basically debit the investment by the share in the increase. Anytime the net asset decreases, what you need to do, you need to decrease the investment. And this decrease in investment means that you will credit the investment to the extent of my God, there's some kind of a trouble today. I don't know what, some kind of trouble which is there. I don't know what it is. Never troubled me that much, my camera. Okay. So in this particular case, what I am saying that you need a continuous tracking of the net assets of the associate company. Continuously monitor that the net assets are increasing, debit investment, decreasing, credit investment to the extent of share in that increase and decrease. But the other $1 million question what comes into account is when you say that you are going to debit the investment, what is the corresponding credit? When you say you're going to credit the investment, what is the corresponding debit? And let me make a life simple on that. The change in the net assets of the associate would mean that he's either, there is a change in equity. Net assets is nothing but equity. So when you say that there is a change in the net assets, it means basically equity. So when you say that there is a change in equity, it could be due to, you have to visualize that is it due to profit and loss? Is it due to other comprehensive income, or is it directly in equity that is directly taken in SOKI? You need to visualize that the change in the net assets, which is equity, is taken at which place? Is it taken in the P&L? Is it taken in the OCI? Or is it directly taken in equity? And trust me, he is going to do a mirror image. He's going to do a mirror accounting in this case. He's supposed to do a complete mirror accounting. He credits the P&L, he credits the P&L. He credits the OCI, he credits the OCI. He credits the equity, he credits the equity. So can you give examples? Yes, I will now. I'll give you examples in terms of what kind of changes you can confront. Watch me carefully. The associate company made a revaluation under Ind AS 16, upward revaluation under Ind AS 16. So in terms of upward revaluation under Ind AS 16, where would the associate company give a credit to the other comprehensive income? So what will he do? Investment debit, OCI credit. So he will take a credit in OCI because the associate company gave a credit in OCI, revaluation surplus. He also gives a credit to the OCI. Let's consider the associate company earned a profit in the P&L section. Let's say he made an income statement in a post-acquisition period and he earned a profit in the post-acquisition period earned in the profit and loss section. So what will I do? I will also give a credit to the P&L, investment debit P&L credit. So what kind of adjustments can the associate company do in terms of equity directly? We have a very interesting case study on that. It's given in the study material, it's given in the educational material also, where the associate company gave a credit in terms of equity. And once it gave a credit in terms of equity, if the associate company credits equity directly, I will also put the entry as an investor, investment debit, equity credit. So at the end of the day, remember the post-acquisition changes is keeping a track of the net assets. It moves up, investment debit. It moves down, investment credit. And the corresponding debit or credits will enter the same accounts, a mirror accounting, what the associate company did. I think let's now try some questions out here. So based on this input now, I want to now take you to a question out here. So let's look at illustration number 8. Let's have a very basic illustration number 8 in the study material, which will give us a very basic flair of how the equity method of consolidation is applied. Let's have a look. On the first day of the financial year, A invested in the equity share capital of B at a cost of 1 lakh to acquire a 25% voting power. Now remember, this is the first day of the year. That doesn't mean that this is the first day of the company investee. You acquired basically on 1st April. That's all. So it says 25% shares of B. A concluded that B is an associate of A. Then he says at the end of the year, B earned a profit of 10,000 and other comprehensive income of 2,000. B also declared a dividend to the extent of 4,000. We need to put the entries in the books of A to account for the investment in associate. The initial entry will always be the basic entry, investment debit, bank credit. Since he made a purchase of investments at 1 lakh, the initial entry to record the investment is investment gets a debit, bank gets a credit, and this is to the extent of cost of the investment. As simple as that. Now, when they earned a profit of 10,000 and 2,000 in OCI, earning a profits in the post-acquisition means the net assets went up. Investment debit. The profit is in the P&L section, the OCI is in the OCI section, so 25% of 10,000 should enter the P&L credit. And 25% of 2,000 should enter the OCI credit. So let's have a look out here. These are now the entries in a post-acquisition period as well. So in a post-acquisition period, if I am looking at the entries, this is for the share of profits in the P&L section. Investment gets a debit and P&L gets a credit, 25% of 10,000. Then the share in the OCI, so investment gets a debit and OCI gets a credit, which is 25% of 2,000. And then once a dividend is supposed to be distributed, now imagine what is the impact of the dividend distribution. The dividend distribution would mean the net assets will go down, so investment is going to be given a credit to the extent of share. So dividend distributed, he'll put the entry dividend receivable, which is nothing but a profit and loss. You can say, sorry, not dividend receivable, sorry, this is going to be bank account debit or dividend receivable, investment gets a credit to the extent of the share. So this illustration throws a complete light on the kind of equity method accounting that you're continuously tracking the net assets of the associate and the corresponding movements are captured. He says P&L, I say P&L. He says OCI, I say OCI. That's the case. So this was a simple illustration. Now I think let's go on to another question. Let's slightly increase the level. Slightly increasing the level, which is illustration number 10. We've got some more better illustrations coming in, but let's slightly increase the level. It says in illustration 10, Blue acquired 25% equity share capital of Green on the first day of the financial year, 1st April. This is for 125. On that date, the carrying value, not the fair value, of the net assets is 3 lakh and the fair value is 4 lakh. So remember, when you identify the goodwill, you need to compare the share in the net assets at a fair value, not the book value. The excess of the fair value over the carrying value is due to the buildings owned by Green with a remaining life of 20 years. And that's a very interesting catch. We're going to discuss that point. Then he says Green earned a profit of 40,000 and other comprehensive income of 10,000. We need to calculate a goodwill capital reserve on acquisition date and blue share in the profit and OCI and the closing balance of the investment. Now, before I take the inputs further, I think let's discuss the post-acquisition movements in this case. Watch this. We are given some very would have been, oh my God, I say something technical. I don't know what happens in this case. Dangerous. So what is the impact of the fair value done on day one? Yeah, I think it's back. I don't know. There's some problem. I'll get it checked up. पता नहीं आज क्या दिक्कत है ठीक है नहीं हम Okay. So I just want to give you another very important inputs at this stage. When you are considering the post-acquisition profits in this particular case, when you took the goodwill calculation, you looked at the net assets at a fair value, which means that when the associate company computed a profit, the question arises, is this profit based on a depreciation taken on a book value, or is this a depreciation taken on a fair value? Undoubtedly on a book value. Because the calculations of the fair value is done for the purpose of consolidation. So which means that the associate company, when computed the profits, their profits in their standalone financials is based on a depreciations on the book value of the assets. They would not have considered the impact of the additional depreciations in this case, which means there will be a need to convert this profits after considering the additional depreciation. Into the profits after additional
हेलो।
Sir, technical problem.
Anyway, I think let's continue back out here. So I'll just quickly give a recap of the inputs what I was discussing. When you're applying the equity method, I would say in terms of the equity method, whenever you are given any fair value adjustments, because when you go to calculate a goodwill, you are going to compare the cost of the investment versus the share in the net assets at a fair value. So the moment you notice in the question that we are given any kind of fair value, remember the profits computed by the associate is going to be something which is based on the net assets at a book value. They would have considered a depreciation based on a book value. So we need to translate this book profits into a revised profits. Remember to consider the impact of the additional depreciation as well. The reported earnings needs to be converted into, you can say, a rectified earnings. Consider the impact of the additional depreciation. So coming to the figures out here, so we were given the carrying amount of the net assets is 3 lakh and the fair value is 4 lakh, and this excess is attributed to one of the buildings which has got a remaining life of 20 years. So we took the additional depreciation 1 lakh spread over 20 years, we get an additional depreciation 5,000. But be careful when you are considering this depreciation. In this case, you acquired the shares on the first day of the year. So which means we're considering an additional depreciation for 12 months. But let's say if the acquisition is somewhere in between the year, you need to consider accordingly proportionate number of months as well. But in this case, we need to consider a full depreciation. So what I did, I converted this 40,000 into a rectified profits after considering the additional depreciations into account. Let's go back. So now I am required to calculate a goodwill capital reserve and also reflect the investments at the end of the year. Now, when you compare the goodwill capital reserve, the investment is acquired at 125. That's given at the very first sentence. And you consider the share in the net assets at a fair value. So 25% of 4 lakh comes to 1 lakh, and you get a goodwill to the extent of 25, which is going to be recorded as a part of the carrying value of the investment. This is initial recognition. The investments will appear in the consolidated balance sheet at 125 with a disclosure in the inner column that the investment is to the extent of 25,000. Let's now go further. So now if you look at the accounting in terms of the post-acquisition changes, if you look at the accounting in terms of the post-acquisition changes, I would prefer to, do this calculations alternatively like this. I would prefer that we can take that this is the rectified profits after the depreciation and you directly consider 25% of this. So instead of taking a share in the reported earnings and then taking an additional depreciation share, my advice would be get the rectified earnings, take a 25% share, and you get 8750. So I would advise that you could directly do the calculations and get this 8750. This is supposed to be the share in the profits. This is the share in the rectified earnings, and then there is also a share in the OCI. So OCI is to the extent of 10,000, 25% of this works out at 2,500. So what is going to be the value of the investment? This is the initial recognition. We add the share in rectified profits, add the share in the OCI, and this is the value of the investment which would appear in the balance sheet. As simple as that. So which means now we have clearly understood a few things which I would like to document as well. But I think let's do one more illustration before we document this part. There is another very interesting illustration in the study material, which is illustration number 12. This is also given in the education material as well. A wonderful illustration on the concept of equity method of consolidation. Now watch this, slightly technical. I hope my system doesn't give way to this illustration, because when I do these technical illustration, it gets annoyed with me. So let's, I think, begin. It says entity A has got a 20% equity interest in B, it's an associate. And in turn, it has got a 10% equity interest in C. A has got a 20% in B, and B has got a 100% stake in C. Now watch this carefully. This is going to take you back to Ind AS 110. So I will explain the transaction very carefully because this transaction needs to be understood to do the accounting of Ind AS 28. Let's see the chain. So I am given A is got in B and B is got in C. It says A has got a 20% stake in B, so B is an associate. And B has got a 100% stake in C, so C is a subsidiary of B. Interesting. A has got a significant influence over B and B has got a control over C. B recognize the net assets. It says B recognize the net assets relating to C 1000 in its consolidated financial statements. Entity B sells 20% of the interest in C to a third party, that is NCI, for 300 and recognizes this as an equity transaction. Now let's understand. We are concentrating on B at the moment, not A. We're concentrating on B at the moment. B has got a 100% stake in C and he sold a 20% stake in C, which means that there is a change in ownership, but it does not result in a loss in control. And I think if you remember the discussions we did in Ind AS 110, that once there is a change in ownership which does not result in a loss in control, the entry is NCI and bank involvement. So in this case, when he sold 20% stake in the company, which means he needs to basically put the entry bank debit, NCI credit. And can you remind me, where would the difference in that entry enter? Because we decided that in this case, it is the shareholders who are entering into a transaction with each other. So any difference in the entry bank debit, NCI credit is going to be parked at which particular place? Do you remember, friends? Because there were two cases. One was a loss of control where we did the reversal entry under 103 and the difference went to the P&L. But this is a case where there is a control which continues, and that's rightly said, equity. So when B made a sale of this investment, he would have done the entry that is bank account debit, NCI gets a credit, and the balancing figure in this entry would have been taken in terms of equity. Let's see the figures. He sold the investment for 300, so the investment is sold at 300. And since the net assets of the entity C is 1000, he would have taken the credit of the NCI at the share in the net assets, that's 200. So any balancing figure in this entry would have been entered in terms of equity, that is SOKI directly. Now, what is the implications in terms of investments A and B? When B made a sale of this investment, B took a credit directly in SOKI. Does this mean that on account of this disposal, B's net asset increases to the extent of 100? Yes, it does. And if the net asset increases by 100, then I also need to increase my investments as well. But where is the corresponding credit going to be taken? Since the associate company is given a credit to SOKI directly, then I also need to give a credit to SOKI directly. This is a wonderful example where we are tracking the change in the net assets of the associate. And since the change is recorded in SOKI, we also need to give a credit to SOKI to the extent of my stake in that company, 20% of 100, that is 20. Let's read further. It says B sells a 20% stake at 300 and it says it recognizes a transaction as equity in accordance with Ind AS 110, resulting in a credit of equity by 100, which I've already shown you. The financial statements of A and B are summarized before and after the transaction. So now we're just getting a little more clarity. We've already got the inputs very clear. The question is practically done. That we are saying that the disposal of the stake in the subsidiary, resulting in no loss of control, resulted in the increase in equity by 100. So since the associate net assets went up, the investor also needs to pass the entry investment debit equity credit 20, but we're still reading the inputs. This is the consolidated financial statements of A, where he has got on the asset side investment in B, and he's reflected an equity on the credit on the liability side. So this is the balance sheet of A, where he is saying this is investment in associate and this is the equity, keeping it simple. Let's see further. Now this is B's consolidated financial statements, where he is reflecting assets from C and there is equity of 1,000. Now let's see the position after the consolidated financial statements when B made a sale of stake of 20% in C. So what happened in this particular case? The assets would continue to be the same, but then there is a cash which came in, bank debit 300. And as far as the equity is concerned, this was the increase, it became 1100, and the NCI appears in its place. Basically incorporating the entry which I gave you. In this balance sheet, you incorporate the entry bank account debit, that is 300, NCI gets a credit, that is 200, and equity gets a credit, that is 100. You incorporate this entry and you get this balance sheet, which you can see that the bank is 300, the equity changes by 100, and the NCI appears at 200, incorporating the disposal entry as a part of the console. So what happens in this case, the equity which was 1,000 earlier became 1,100 now. So because of the disposal of a stake in the associate, in the subsidiary company, we can say it resulted in increase in the net assets or equity by 100. Although A did not participate in the transaction, entities A share of net assets in B increased as a result of the share. Effectively, A share in net assets is now 20% of 1100, that is 20 more than the previous share. How is an equity transaction recognized in the financial statements of B reflected in the consolidated financials of A that uses an equity method to account for the investment in B? So as I said earlier, he also needs to record his share of 20%, that is 20. So I'm just putting the inputs below. Thus, in the given case, A recognizes 20 as a change in other equity. Instead of a statement of P&L, maintains the same classification of the associate, that is a direct credit to equity in the consolidated financial statements, which I said earlier, that if the associate company credits P&L, investor credits P&L. The associate company credits OCI, the investor credits OCI. The investee company credits equity, the investor credits equity. Now you've seen all the three cases where the P&L was given a credit, OCI was given a credit, and the equity is given a credit. I think it's time to do some mapping of the concept as well. I hope, friends, you've well understood the equity method of accounting under Ind AS 28. Let's map this up, then we go to the next area of discussions. So let me now pen this down out here. So I am just going to add some inputs on the equity method. So there are a few highlights which are coming to my mind as far as accounting under equity method is concerned. So what are the basic highlights when you're looking at the accounting under the equity method? Let's have a look. So I would divide the accounting, I would say, in two stages. I would divide the accounting in terms of two stages. Stage number one. The stage number one is supposed to be the initial recognition. The stage number one is the initial recognition, and I would say the stage number two is supposed to be the post-acquisition changes. It is supposed to be a post-acquisition changes. In a nutshell, we can simply put it like this. That if you're looking at the initial recognition, what do you need to do? You just need to compare. You just need to compare the cost of the investment versus the share in net assets. And that would be at fair value. And that would be at a fair value. Just compare the net assets and the cost. So what you're going to get is the goodwill, or we're going to get a capital reserve. And this goodwill capital reserve is going to be a part of, it'll be a part of the carrying amount of investment. And just to be very clear on this, not a separate line item. It's not going to be a separate line item. So in this particular case, the goodwill is going to appear as a part of the in the column disclosure, recorded as a part of the carrying value of the investment. That's it. Then comes the input with reference to the post-acquisition changes. So what I'll do, I'll take the investment, which is the base, which is the cost itself, and we need to basically do what? We need to basically track the changes in net assets. We need to track changes in the net assets in this particular case. So we can say if the net asset increases, your investment also increases. It is debited to the extent of the share. And if the net asset decreases, then the investment is supposed to be credited to the extent of share in that decrease. And we clearly said that when you're going to do this, certain caution areas now. So when you do this, you need to consider, number one, post-acquisition profits. When you take the post-acquisition profits, remember to take rectified profits. Remember to take the rectified profits, which is after additional depreciation. Remember to take the profits which is after the additional depreciation. That is one caution. Then when you take the post-acquisition earnings, consider the rectified earnings, which is after the additional depreciations. And the other inputs to be taken care is number two, that the corresponding debit or credit, in this particular case, when you're going to do this accounting, the corresponding debit or credit is going to be same as associate. We will see what did they give a credit to. So it could be in terms of P&L, it could be in terms of OCI, or it could be in terms of equity directly. So this is the key considerations to be kept in mind. So what is the rectified profits? Well, if you remember, when I took the post-acquisition profits, that 40,000 was the profits in the example. We reduced the additional depreciation of 5,000 and converted this into a rectified earnings. So when you're going to consider the share in the post-acquisition earnings, convert that reported profits 40 into rectified profits, consider depreciation impact. Right, friends, so far so good. My block number 2 is done now. I am now going to go to the block number 3, which is the special agenda. I hope everything works well, because this is now going to be slightly technical in nature. So let's do one thing. Let's, I think, now take it further. And I'm going to do a very interesting illustration, which is given in the study material. This is dealing with the concept of long-term interests. This is my block number 3, which is long-term interest. So I'll explain this with a comprehensive illustration also, which is given in the study material. Now this is a slightly technical area, so watch this carefully. The next 15-20 minutes is going to be very crucial. And so this is my block number 3, where we're discussing a special issue. Now let's see what is the special issue. I'll give you a framework. I'll go slow on this, but get the facts very clear. It says long-term interest in associate or joint ventures apart from equity investments. There is a possibility that as far as the investor is concerned, he has got, other than equity investments, some other long-term interests. So what do you mean by a long-term interest? Friends, if you've done the concept of Ind AS 21, you would relax, you would collect something called NIFO. That's called net investment in a foreign operation. Do you remember that there is a concept where the parent company could have, given some money to the subsidiary, which is, with the intention of not taking the money back. It's neither planned nor it is, pre-decided that you will settle that particular transaction. The parent company is trying to put some money into the subsidiary, and that is called a net investment in a foreign operations. Do you recall the concept in Ind AS 21, friends? I don't know if you recall that or not, but Ind AS 21 also tells you that there is a concept of some kind of investments in a subsidiary other than equity investments, which is as good as a permanent funding, which is called a net investment in foreign operations. Nobody said a yes on that. It's okay. Let's go further. Now, when you say long-term interest, the standard tells me what are long-term interest. An entity might hold financial instruments in an associate or JV other than investments accounted using equity method. So we're saying it's other than equity investments. These long-term interests are in substance a part of the entity's net investment in an associate or JV. I call it as net investment in associate, NIA, or net investment in JV, NIJV. If you recall, a similar concept is given in Ind AS 21. It's called NIFO, net investment in a foreign operations, which is like a permanent funding which is done in a subsidiary. Similarly, in an associate company, you could invest in terms of preference shares, for example, or maybe some kind of long-term loans where the intention is not to take this money back. It's neither planned nor intended that you will take that money back from the associate company. So it says, for example, an item which settlement is neither planned nor likely to occur in the foreseeable future is an extension of entity's investment in that associate. So he says that there is a possibility that as an investor, you've given some money to the investee where the intention is not to take the money back. It very clearly makes a mention, an item for which settlement is neither planned nor likely to occur. You've not planned the settlement of the transaction. You've not even planned, and in this particular case, it's not likely to occur. It is as good as an equity investment. It is something which we can say in substance an equity investment. So Ind AS 28 draws a light on the fact that as an investor, apart from the equity investments, if you put in money into the associate, which is in substance something as good as equity investments, there is a special guidance which governs the accounting. Such items may include, it says, preference shares, long-term receivables alone, but they do not include any trade receivables or trade payables. So I need to watch out for other instruments. Is there a long-term loan? Is there a preference shares? But not simply preference share does not mean it gets covered out here. You need to prove the fact that the investor invested in the preference shares or the loans or the long-term receivable, and you are neither planning the repayment nor it is going to happen in the foreseeable future. You gave a money to the associate company, long-term receivable. I said, don't worry, there's no need to pay. I've not planned him to ask me to pay the money, nor he's going to pay me in the future date. It's as good as permanent funding. It's as good as equity investments. So let's see another inputs now. Let's see the illustration to walk through. Now this is the illustration 15 of the study material. Now before I read the illustration, it is important to first give you a chain of thoughts. It is first important to give you a chain of thought. So please hear this chain of thought very carefully. When I am applying the equity method, When I am applying the equity method, what comes to my mind is two permutations combination. I would say there are two kinds of questions. The question number one is that there is only equity investments. There is only equity investments. And the case number two is that there is equity investments and there is other long-term. There is other long-term interest as well. So you need to watch out in the question that what category of question are you looking at. Watch this carefully. This is a very important thought which I'm giving you. So when you look at a question under Ind AS 28, you need to see that in the question there is only equity investments or there is equity plus other long-term interest as well. Now, in all the questions we have seen so far, it was only equity investments. Now, if it is only equity investments, there can be two cases. And even if it has got equity and other long-term investments, there can be two subcases. So practically there can be four kinds of questions in the exam. So one category is that there is only equity investments and the associate company is supposed to be a profitable company. Or we say the associate company is a loss-making company. So there are two cases. The associate company is a profit-making company or the associate company is supposed to be a loss-making company. Now, if you say that the associate is a profit-making company, we've already seen questions out here. We've already seen questions, track the net assets, investment debit, and that's how the accounting is done. Now comes the catch. If the associate is a loss-making company, now goes the problem. Let's say the investment is appearing at 200. Let's say the investment is appearing at 200 and the share in the losses is more than 200. So let's say in this particular case, the investment is appearing at 200 and let's say the share in losses. Let's say the share in the losses is to the extent of 250. The investment in the balance sheet will now appear at 0. The investment in this case will appear at 0. And you will show in the notes to accounts that there is an unabsorbed loss of 50. That's it. So in this particular case, if the associate is a loss-making company, you can say that if your share in losses in the associate is more than the carrying value of the investment, you need to show the investment in the consolidated balance sheet at a 0 value. And in the notes to accounts, you'll have to write down that there is an unabsorbed loss of 50. Now again comes the other case. The associate company is a profitable company and the associate company is a loss-making company. Now let me tell you in this particular case, if the associate company is a profitable company, this particular long-term interest doesn't get triggered. The appendix in this particular case, the guidance given in the appendix, what I'm about to tell you is not applicable. Mind it clear. The guidance which is given in the appendix in this case will not get triggered. So this guidance will get triggered only in this case. This guidance which I'm giving you right now in illustration 15 will trigger only in this case. So when does the guidance of the special issue trigger? There are two parameters. The parameter number one is that as an investor, you've got equity and other long-term interest, and the associate is a loss-making company. If the associate is a profitable making company, then this guidance will not get triggered. So remember, the role of other long-term interest will trigger only and only if the associate is a loss-making company. I hope, friends, I've made myself clear on the agenda. So I'm now going to show you a walkthrough of how this appendix makes an impact on the accounting. So far, so good. Did you get my point? That when does this appendix gets triggered, that there is an associate company which is a loss-making company and you've got other equity, other interest as well, then it gets triggered. Great. Now let's have a look. Let me now come back on the illustration and let's make a walkthrough. It says loss-making associate and and long-term interest. I think now the heading would also make complete sense to you. It says long-term interest and a loss-making associate, then only the appendix gets triggered. An entity has the following three types of interest in an associate. You've got a 25% equity shares to which equity method of accounting is applied. This is equity investments. There is preference shares non-cumulative that forms part of net investment in an associate, NIA. It's a net investment in the associate, which means it is supposed to be as good as equity investment long term, no intentions to get the money back. And such preference shares are measured at a fair value as per 109. Then there is a long-term loan. The interest income is received at the end of each year. This is accounted as per amortized cost as per 109. And this also forms part of the net investment in an associate, NIA. So it's going to be NIA or NIGV, JV, net investment in joint venture, net investment in associate. The moment the question says NIA, net investment associate, NIJV, net investment in joint venture, it is indicative that this is supposed to be other long-term interest in the associate company. Now, so they've got two more other long-term interest in this case. At the start of the year, the carrying value of each of the investments is given, equity, preference, long-term loan. The following table summarizes the changes in the fair value of preference shares as per 109, impairment losses on long-term loans, and the share in the profit or loss. You can see losses in the initial year. So the presence of a long-term interest and the presence of the losses clubbed together triggers the appendix. Now, one thing which we need to be careful on the other portions of the language. It very clearly says that as far as the long-term loan is concerned, it is accounted at AC. So long-term loan is subject to impairment testing under 109. The preference shares is still measured at an FPTPL. It is not subject to impairment testing, but it is going to be recorded at fair value. So preference shares is the fair value changes to be captured. And in terms of long-term loan, impairment losses to be captured. So he tells you that in all these years, this is the increase or decrease in the fair value. This is the impairment loss or the reversal of impairment loss. This is impairment loss. This is a reversal. This is fair value decrease and this is fair value increase. And this is the share in the post-acquisition profits or losses of the associate. Throughout year 1 to year 5, there is no objective evidence of the impairment in the net investment in associate. The entity does not have any legal or constructive obligation to share the losses beyond the interest in the associate. Based on the above, determine the closing balance of each of the above at the end of each of the year. Now watch this carefully. It's not complicated, but you need to be very careful on the calculations. Let me go to the year 1 first. Let's go to the year 1. We have to go to all the 5 years one by one. So we need to go to all the 5 years one by one. So I am going to go to first of all year 1. Now watch this carefully. This is the opening balance of the investments already given in the question. I've just copied this from here. 10 lakh, 5 lakh, 3 lakh. This is the value of the investments. Now, I'm focusing on other long-term interest. I'm focusing on other long-term interest. So the focus is on the preference shares and the long-term loan, not on the equity as of now. You first apply the relevant standards of them. To the preference shares and to the long-term loans, go for Ind AS 109. For preference shares, record the fair value changes. For the long-term loan, record the impairment losses. Now, if you go back to the additional information, we can see that there is a fair value decrease for preference and there is an impairment loss for the loan. So we can see what do we need to do. I need to record the fair value decrease, bring it to 450. I need to record the impairment loss and bring it to 250. Step number one. This is step number one. What do you need to do? You need to apply the relevant standard to other long-term interest. The relevant standard would be 109, of course. So in this particular case, you take care of the fair value decline or the impairment loss and get the values after applying 109. That is step number one. So this is like the step number one, that you need to first apply the concept of 109. Now we go to the step number two. Now we go to the step number two in this particular case. Now what do you do in terms of step number two? Let's go back and see what is the share in loss. The investor has got a loss of 16 lakhs. He's got a share in the net loss. This is the share in the losses 16 lakh, but the value of the investment is only 10 lakhs. How can he bear a total loss of 16 lakhs when the value of the investment is 10 lakh rupee? So the 6 lakh which he cannot absorb will be borne by these preference and the long-term loan. So what do we do in step number two? Out of the 16 lakh, 10 lakh is given to the equity. This is Ind AS 28 accounting. This is Ind AS 28 accounting, that you give him 10 lakh rupees of loss to the extent of the carrying value of the investment. And then this is the appendix accounting. This is the accounting for the special issue. The remaining loss of 6 lakhs is to be divided between these two people. How would you divide this? The remaining 6 lakhs is to be divided between these people. How would you divide this between these two people? This will be divided in a given order. This will be divided in the given order. If the company would liquidate, who will get the money first? The loanser and then the preference. So if the loan gets the money first and then gets the preference, so first kill the preference. Give the loss to the preference and then give the loss to the loan. See the order in which money is given to them on liquidation. The loan holders get the priority 1. The preference gets the priority 2. So when it comes to giving them the benefits, the loan people gets the benefit first. The preference gets the benefit later. So that means the losses will be first borne by the preference and then borne by the loans. Now, as far as the preference is concerned, his value as per step 1 is 4,50,000. So you give him 4.5 lakhs. And whatever is the remaining 1.5 lakhs is given to the loan. And therefore, we get this 150. Get this clear. Go step by step. So what do you need to do? First of all, in step number 1, you need to account for Ind AS 109. Account for the long-term interest as per 109, book the fair value change, book the impairment loss. Then step number 2. Step number 2 has got 2 parts. Step number 2 has got 2 parts. Step number 2A and step number 2B. In terms of step number 2A, give the share of losses to the associate equity to the extent of the investment value. Any unabsorbed losses of 6 lakh is to be allocated first to the preference and then to the loan, and accordingly step number 2 is done. Got the point, friends? And then comes the step number 3. And then comes the step number 3 in this case. Of course, this value becomes 0, this becomes 0, this value becomes 1 lakh, but this is not step 3. I would say in terms of step number 3 is you get what is still, you need to get what is unabsorbed loss. You get what is the unabsorbed losses. See what is still carried forward which could not be absorbed. In this particular case, the entire 6 lakh was allocated, but there could be some loss which could not be allocated, because the value of the loan and the value of the preference shares might have been lesser than 6 lakh. Let's say if this 450 or this 150 cannot be allocated to them because their value of investments is less, there will be some allocated loss. So in step 3, just track that unallocated loss. Right? Now, let's go to the next step. So in this particular case, what I gave you, that in step 1, account for long-term interest as per 109. In step number 2, what do you need to do? Account for two things. Step number 2A, Ind AS 28, pass on the loss to the equity interest. And then step number 2B, for the remaining loss, hit the other long-term interest. And then step 3C, if there is any losses which could not be absorbed. Let's go to the next year. Let's go to the next year now. Now, if you look at the next year, we've got again a loss to the extent of 2 lakh. There is a share in loss to the extent of 2 lakh. So this closing becomes the opening this year, and we can see that these are the balances which are opening. Again, step 1, step 2AB, and step 3. Don't go fast. Step number 1, 2AB, and step number 3, step by step. So in terms of the step number 1, you need to concentrate again on the preference and the long-term loan. In terms of the step number 1, you're going to concentrate again on the preference and the long-term loan. Let's see the fair value changes and impairment. There is a fair value decrease, but there is no impairment. So book the fair value decrease. But how will I book the fair value decrease in step 1? There is no value. There is no value. And why was there no value? Because of this Ind AS 28, he was given a loss of 4,50,000. Had Ind AS 28 not been there, I would not have given him 450. Get the point clear? Because of Ind AS 28, you gave him a loss of 4,50,000. Had Ind AS 28 not been applied, I could have easily recorded that fair value decrease as well. So no worry. Roll back Ind AS 28. Roll back Ind AS 28. So whatever 50,000 loss was allocated here, reverse it back. You need to reverse it back. Since I want to apply my Ind AS 109, since I would apply my Ind AS 109, because of giving him a share under Ind AS 28, I cannot record the post fair value change. So reverse back. So we will reverse, then say we're not allocating that 50 to him. So what I'll do, this 50 will be adjusted against the reverse back figure. It'll be adjusted against the reverse back figure, which means effectively he's been allocated 4 lakh. Which means effectively he's been allocated 4 lakh. 450 was reduced in year 1, 50 is added in year 2. So we'll add back 50,000 in year number 2 only because I want to make the adjustments of the fair value change in this case. So what was the losses out here? We saw that as far as the losses out here is concerned, it is 2 lakh. So this 2 lakh was the loss. Instead of giving 2 lakhs, I had to reverse 50,000. Instead of giving 2 lakhs, I had to reverse 50,000. Now, let's see. In this case, this is 1 lakh. So he can be definitely in this particular case. First of all, now let's go to the step number 2. In terms of the step number 2, as far as equity is concerned, he has already become 0. I can't give him anything in step 2A. As per the step number 2A, I can't give him anything. Since I can't give him anything, so what happens? He will bear whatever is the carrying value in step 2B. I'll pass on the entire 1 lakh loss to him. So get the points. There are two things. The long-term loan gets a, you can say, allocation of 1 lakh loss. The preference share gets a reversal of 50,000. The long-term loans is allocated a loss of 1 lakh and the preference share gets a reversal of 50. So indirectly the allocation is done only to the extent of 50,000. So out of the total loss of 2 lakh rupees, you can say the step number 3 is telling me that there is still 1.5 lakhs which is unallocated. Because out of the 2 lakh loss, I could only effectively allocate 50,000 because I gave 1 lakh to the long-term loan, but reversed 50 to the preference. So the allocation became 50. So out of that 2 lakh loss, only 50,000 got allocated. Therefore, 150 carried forward to be adjusted in the next year. 150 carried forward to the next year to be adjusted. Now all the balances have become 0. So we go to the next year now in this case. We go to the next year now in this case. And in the next year now, what do? We start with the opening balances. The closing of year 2 becomes the opening this year. Now you need to keep in track that there is 150 which is carried forward unabsorbed loss. We go back and see that in this particular case in third year, there is no share in loss. There is no share in loss. There is a fair value gain and there is a reversal of impairment loss. Now watch the third year carefully. Step number 1, Ind AS 109. In step number 1, the focus is Ind AS 109. So now there is a fair value increase, give them the fair value increase. There is a reversal of impairment loss, give them the reversal of impairment loss. So you get the values which are based on, you get the values after Ind AS 109. Step 1. Now comes step number 2A, equity. As far as equity is concerned, it cannot be given anything in step number 2A. In terms of step 2A, it is already 0. I can't give him anything. I can't give him anything at this stage. Since I can't give him anything, remember this was the carry forward loss as per the previous step. So in step number 2B, it gets triggered that there is a carry forward loss to the extent of 1.5 lakhs. I now need to allocate this in a given order. And what is the given order? First to the preference and then to the loan. How much can you allocate to the preference? The preference is appearing at 1 lakh, so 1 lakh allocated to the preference. The loan is appearing at 50, so the remaining 50 can be allocated to the loan. Fortunately, the amount of the preference and loan equals the carry forward loss. It could not have. Then in step number 3, you would have again seen what is carried forward. Now the carried forward is 0. So when you're looking at the step number 2B, the carry forward loss of the previous year needs to be tracked as well. And in this particular case, you need to allocate it to the preference and the loan. Then comes year number 4. I know this is highly complicated. And one needs to sit down and do the tracking as well. Now let's look at the table, the year number 4 in this case. If I go back to the year number 4, so in year number 4, there is again a fair value gain and there is no impairment loss. And now he is getting a share in profits 10 lakh. Now there is a profit shares in year number 4. Let's again go back. The closing balance in this case becomes the opening balance in the next year. Step number 1, Ind AS 109. So focus on the preference shares and the loan. There is a fair value gain. There is no impairment loss or reversal. So this is the values based on the step number 1. Now comes that there is a gain. Now another crucial point. Now comes that there is a gain of 10 lakh. Who gets the gain? Let's first compensate the loan. Then let's compensate the preference and then compensate the equity. So in terms of the step number 2, as soon as you get a profits, you need to again decide the order in which the profits will be given. The first person who always gets money on a liquidation is the loan. So given the loan gets the profit, then preference gets the profit, and then equity gets the profit in the same order. We need to see that when a company is going to distribute anything, the priority of distribution is loan, preference, and equity. When it was distributing losses, it was equity, preference, and loan. So in this particular case, what we do, we go and calculate how much losses have you given to the loan so far. You go back to year 1, 2, 3 and see how much losses you have given to the loan so far. If I go back and see, to the loan holders, I gave a loss of 150 and I also gave them a loss of 1 lakh. To the preference, it was 450 and a reversal of 50. So loan holders is 150 and 1 lakh, 250 and another 50, 3 lakh. In the previous 3 years, the loan holders have been allocated a loss of 3 lakh. So we first give them 3 lakh. And if you go to the preference, you gave them a loss of 450, reversed 50, makes it 4 lakh. And you give a loss of 1 lakh. So they've been given a loss of 5 lakhs till date. So the balancing figure 2 minus 8, he gets 2 lakhs. Since the associate share is supposed to be 10 lakh, he gets the balance 2 lakh in this case. The losses which were allocated to them earlier have been reversed back in the order loan, preference, and then equity. So this gives me, and now in terms of step number 3 also, there is no carry forward loss. Keep a track of the carry forward loss. So now the value of the investment comes out here, and we go to the year number 5 as well. And now we go to the year number 5 as well. And in terms of the year number 5, I need to again go back and see what is the position in year number 5. There is a fair value gain, but there's nothing, and there is a share in profits. So in this particular case, again, your focus is 109. Your focus step number 1 is 109. Record the fair value change. This is step number 1. Then you go to the step number 2 in this particular case. Now, in terms of step number 2, since there is no carry forward losses, loan holders compensated back the loss, preference compensated back the loss. So the entire profit of 10 lakh becomes equity, goes to the equity itself. Because now there is no carry forward, so everything goes to the equity, and now this becomes the revised values in the books of accounts. Wow. So this is the case of how the accounting would look like, complicated. So moral of the story, which I would just like to quickly pen it down, that when you're applying this concept, my advice would be again a 3-step model. Go with this. When you revise, go with this. I would say, in terms of step number 1, what you need to do, you need to first of all apply Ind AS 109. So first you're going to apply Ind AS 109. Look at the fair value changes, look at the impairment, account it. Then you go to the step number 2A. Then you go to the step number 2A, and what do you do in terms of step number 2A? You will allocate losses to equity. You will allocate the losses to equity. So this is applying Ind AS 109 to the loan and to the preference, or the long-term interest. In terms of step number 2A, you need to allocate the losses to equity. Then you need to go to the step number 2B. And in step number 2B, then you will allocate the losses. Then you'll allocate the remaining losses. You will allocate the remaining losses, you can say, to the loan and preference, and that would be first to the preference and then to the loan. So this is the step number 2B. So you need to be careful. First take care of 109, then you need to allocate to equity any remaining losses to preference and debt, and then keep a track in terms of step number 3. And in terms of step number 3, see what is the carry forward loss. In any case, in between, you'll see the complications also coming in. So I believe I've reached my quota of technical discussions for the AM positive, but I'll get it when I rewatch it. Yes, you'll have to watch this again as well. And in any case, if you want, I can give you a brief in the next session on this area also, because next class is going to be on conceptual framework. We might take out a little time to give you a briefing on this if you want that. What is the probability of coming this in the exams? You never know. But it's not that tough. I can give that as well. Sure, we'll do that. We'll give you a brief in the next class on this area. Also take out some time towards the end to give you a workings by hand. So this is the basic 3-step model which you need to apply in terms of this appendix. And in between, of course, there are certain complications, like when you're allocating the losses to equity, and then when you allocate to the remaining to the preference, you need to keep a little tracking in terms of reversing back and all. So this step can involve reverse back. So that is one key agendas which you need to take care. And when you apply the step number 2B, you also need to see the step 3 as well. So there are some complications which are there, but the basic flow of the steps is the 3-step model. Right, friends, I think this must have been very heavy indeed. I already said the block number 3 is the most technical part of this standard. But this fortunately brings us to the end of our consolidation journey. And I will be seeing you in the next session as well. We've got a theoretical kind of a chapter, not very practical questions and all. A relief back on Saturday, which will be on the conceptual framework. And that would also be my last topic of things with you. So I think we'll try to steal some time from that session as well. Give you a little briefing maybe towards the end as far as the area of this associate accounting is concerned. We're going to spend some good time to give you a hang. Just revise this bit, have a look at the video once again and watch this out. Get your frameworks clear so that once we do a quick revisions on this, you get a solid guidelines on that. Right, friends. So I think over to you for any questions on your mind. I think I am otherwise done for the day. So if you've got any question, friends, please feel free to ask. My apologies for the kind of technical difficulties, technical in the sense the camera went off and all. My apologies for that. I get it checked. Hopefully it should not disturb us next time.
Sir, I have a doubt.
Yes.
Yes, sir. So, for calculation of NCI in change of ownership. Hello?
Haji Peter.
Sir. For the calculation of NCI in change of ownership, the value of NCI is to be taken for during the transaction or the NCI before the transaction. Like, for example,
On the date of
if
transaction.
okay, like sir, if A has 90% equity, 90% shares and 10% NCI, and he is proposing to sell 20% in the transaction. So NCI will be 20% or 10%?
Now, in my journal entry, NCI changes from 10 to 30, right?
Yes, sir.
So in the journal entry, I will basically credit the NCI by 20% figure.
Okay, sir.
The change. Because, when you're putting the entry bank debit NCI credit or NCI debit bank credit, that entry is with the change in the NCI. So if it is 10 to 30, you need to record 20%.
Okay, sir. Thank you, sir. That was the
You're
doubt.
welcome, Beta. All right, I guess, friends, that seems to be good for the day. All right, I think then it's time to bid you goodbye, friends. I'm going to see you in the next session. Thank you very much and see you next time. Bye-bye and take care.
Thank you, sir.
Thank you, Beta. Anji, thank you. Same to you, Ji.
Thank you, sir.
Thank you, Beta.